It's showtime. Let's do it, folks. Good morning. Welcome to TheStreet Today here from Post 35 on the floor of the New York Stock Exchange. Today is Wednesday, February 1st. I'm your host, JD Durkin. That's what the box says. We're about an hour or so into trading, and stocks are where? Are they in the red? Are they down fractionally? They're still in the red. Yeah, they're down in the red. Fractionally, though, it's like wait and see mode. It's like Mr. Powell's going to speak. What's going to happen? More earnings on tap. Got to let the dust settle. Got to digest it. Take a deep breath in. That's what investors are all doing today. And then, of course, like I said, we await the interest rate decision from the Federal Reserve, as Martin Baccardax knows better than anyone. We will get the decision at 2. We will get the press conference at 2:30-ish, somewhere in there. And, of course, we very closely follow the Q&A portion of what Mr. Powell has to say as soon as the script is formally gone. On the show this morning, let's talk about what's on tap. We will talk Fed. Of course we will. It's Fed Day. Happy Fed Day. As the central bank is expected to raise rates another 25 bips. Plus, we'll talk tech earnings as names like Meta, Alphabet, Apple gear up to release quarterly results today and tomorrow. And finally, we'll be breaking down Peloton's fourth quarter report. Been a while since we talked Peloton as the company's losses continue to narrow. For more on those stories and so much more, we now welcome back our senior editor and chief markets correspondent, Mr. Martin Baccardax. Martin, how are you celebrating Fed Day? And also, do you have a Fed Day go-to snack, I wonder, that you like to enjoy on days like this?
I do. At the risk of endorsing any particular grocery store chain, JD, my local grocery store, as it happens, on each Wednesday has $5 sushi. And I know that sounds unpalatable, but I do live very close to the ocean, so I'm comfortable with the seafood caliber. So that is my indulgence on Fed Day. I grab that sushi, bring it back to the desk, and settle in.
Is it Publix? I don't want to reveal too much about where you are. Yeah,
yes, it's Publix.
Listen, love me some Publix. I will be down in Florida next week. I've already told my mother. First stop, as soon as we land, we're taking the rental car. We're going to Publix to stock up for the week. All right, let's talk Fed here. Of course, it's the big story of the day. The Federal Reserve is expected to close out its two-day FOMC meeting with a decision on interest rates. The question of the morning, Martin, will it be 25 basis points or will it be 25 basis points?
Yeah, almost certainly. I mean, markets have been pricing in this 25 basis point certainty for a good number of weeks now. We're basically now at a 99% chance based on the CME Group Fed Watch. But that has been the sort of standard bearer really since the beginning of the year. I would be terribly surprised if the Fed didn't deliver on that. But I think the expectation is such that any deviation from it would be certainly unsettling. But I'm almost certain that that's what we're going to get. What comes next, JD, is the fact that the Fed is not going to release economic projections or dot plots or anything else alongside the statement today. So that is going to mean that investors are going to be laser focused on the language in the statement, which comes at 2 p.m. Eastern, and of course the tone from Chairman Jerome Powell when he speaks to the media 30 minutes later in Washington. So to some degree, the press conference has raised itself in terms of the potential for market change, and it's become far more significant in this meeting than perhaps the past few others. The dot plots were probably the most significant development from the December meeting. This time round, it's definitely going to be Chair Powell's press conference and the Q&A session.
So let's talk about that dot plot, because I think for the March slate, it's a really interesting tool of communication. So for people that are otherwise unfamiliar, what can we learn from the dot plot? It's largely, it is anonymous. We don't exactly know where, and it's going to give us a gauge for where they think the next meeting goes, where they think the terminal rate goes. What can we learn from that piece of data if and when people continue to hear that phrase throughout the afternoon?
Well, that's the best way, I think, JD, for us to understand where the whole of the FOMC is sort of projecting the terminal Fed funds rate. That's probably the one that we look at most closely. It's a collection of those projections from all of the members of the Open Markets Committee, and it's laid out on a very easy to understand graph. And as a result, you can pick or pinpoint where the collective thought is with regards to that Fed funds rate. Now, back in December, when you looked at the plots on the graph, it came to the conclusion that the Fed was going to peak with the terminal Fed funds rate of about 5.1%. The language after that was pretty clear as well and consistent, that Fed officials said, we're probably going to get to that 5% by May, and we're going to hold on to it until the end of the year. that messaging has not changed, even though data since then has been pretty consistent with the downward slope of both inflation pressures and indeed broader economic growth. So that has led to the suspicion that traders are betting against it, and they don't think the Fed's going to hold at 5%. They don't even think the Fed's going to get above 5%. And there's actually now some betting on rate cuts over the back half of the year. That's probably quite optimistic. It will be very dependent on what kind of recession, if any, the US is going to tip into. But nonetheless, the change in tone from the market compared to no change in tone from the Fed has been an interesting dynamic really since the December meeting, and it's carried on into this morning's trading as well.
So what will you be most closely following? Is it the comments? It's the Q&A?
Yeah.
It's a little bit after? Aside from the number
I think
itself,
so.
right?
I think basically he'll repeat the statement in verbal form when he addresses the media at 1:30, and then he'll begin to take questions from the assembled journalists. I think what will be interesting, or what I'm certainly going to cotton on to, JD, is what he has to say about the labor market, because that remains the wild card in all of these discussions. I don't think there's any debate with respect to the trajectory of the broader economy. Leading indicators are really at their weakest in a number of decades now, and the level that they are indicating has been almost unanimously associated with recession. The ISM Manufacturing Index, which came just this morning, it measures manufacturing activity around the whole of the US economy, I think is down for a fourth consecutive month, the lowest since May of 2020. So we're cratering there. And obviously the housing market is rolling over, and indeed all the rest of it. But with labor, it remains really, really tricky. Essentially, we had certainly a decrease in the labor cost index, and that's really, really important. And by that, I mean companies aren't chasing new hires with significantly higher wages. And as a result, the cost that they incur to bring in new employees is decreasing. That's good for wage pressures, and as a result, good for broader inflation. But just this morning, JD, we had two pieces of information. One from ADP in its National Employment Report, which showed a big jump in year-on-year wage gains for people who have left one job and taken on another. And the second number that we saw, which was really significant, at least in my mind, was that labor turnover report, the JOLTS report that comes out every month in 2-month arrears. Essentially what it said was that in the month of December, there were 11 million unfilled positions. The change between November and December was the biggest, I think, in about 18 months, and caught everyone by surprise, and again just indicates the unbelievable resilience in the US job market. If that resilience were to translate into higher wage growth, then the Fed would absolutely not be able to change tack on its rate hike path, because it would be too worried about a wage price spiral. So Mr. Powell may have found himself some cover today as a result of those the jobs data, the wage data in particular, to tell markets that he needs to wait for another couple of months in order to be certain that inflation is slowing to his liking, and that wages are not sort of triggering the potential spiral that they could if he were to take his foot off the gas.
I like to ask you this the day of every Jay Powell press conference, Martin. If you were in the room with Mr. Powell this afternoon, he's scanning who he wants to talk to, he sees the great Martin Baccardax, and you say, Martin Baccardax here from the street, he would say, what's your question? So I ask you, Martin, what would you ask Chairman Powell today?
I would say, is the risk of going too far on rate hikes now starting to outweigh the benefits of ensuring that inflation is getting close to that 2% target? The data on CPI is pretty consistent. The annualized rate of core inflation over the 3-month ending in December is down to about 3.1%. That's not far off what we're seeing with respect to the Fed's target. All of the mechanics seem to point in that direction, and yet the Fed is still talking about further rate hikes. So if I were to distill down my question, I think, JD, that's what it would be. Are the risks not balanced to doing more rather than less, given the change in inflation dynamics that we've seen over the past 3 or 4 months?
People like to say, don't fight the Fed. We've heard that for quite some time. What does that mean in terms of today's cycle, given everything you just laid out? Core inflation numbers, everything else, the jobs figures that we got this morning, both from JOLTS and ADP. What does don't fight the Fed mean today?
Not too much, to be honest, JD. I mean, the market seems to be fighting it across the board. We just had the best January for the S&P 500 since 2019, the best January for the NASDAQ since 2001. Essentially, as I say, there are rate cut bets in the marketplace right now for the back half of the year. Benchmark 2-year Treasury notes, which is good proxy for the terminal Fed funds rate, are trading at around 4.2%. Not only is that almost 100 basis points south of the 5.1% that the Fed says they want to get to, but it's south of where we already are in terms of the Fed funds rate, which is at 4.25 to 4.5%. So I'm seeing small battles all over the financial market landscape against the Fed's signaling on interest rates. That, of course, just makes this afternoon's meeting a bit of a high noon with regards to what the market wants and what the Fed is going to deliver.
Yeah, again, we're mostly trading down fractionally. It's kind of a little bit of a wait and see game here happening, perhaps. But of course, we're weighing lots of other things. Anything else here for the Fed that you would like to talk about before we get into general markets and then eventually inch our way towards earnings? Because there's no shortage of things to talk about, for good or for bad. But I wonder what else is important to you in terms of the FOMC today.
The only other two things I think that leap to mind, JD, are the fact that the Bank of Canada last week did increase its benchmark lending rate, but it said, or at least it signaled, it's more likely to pause than to carry on going forward. So that does seem to suggest at least one major central bank is looking at the implications of this downward trajectory in inflation. And just this morning, we had CPI data. Well, they don't call it CPI in Europe, they call it HICP, but nonetheless, inflation data out of Europe had a significant slowdown in the month of January. It's still elevated at 8.5%, but it was far lower than the street forecast, and indeed far lower than it was in the month of January as well. I've had a very mild winter so far, gratefully, because they were facing an energy crisis had they not experienced this. But we are seeing that decline in inflation in major economies around the world. And if those dynamics are consistent and echo here in the United States, then we can become more secure about inflation projections here in the world's biggest economy. So I think that's going to play into the thinking going into the press conference today. But I truly believe that Powell has found some cover from that labor market data, and he will try to weave that into his narrative as he tries to push back on market expectations and just ensuring that his messaging remains consistent.
Absolutely. So let's now pivot to the broader indexes. We were talking about how good January was. Remind me, this is the best January for the S&P since what year?
Since 2019. So 6.2% was the gain for the whole of the month of January. I think that has to be set in context, though, JD, because we had about a 6% drawdown for the S&P 500 over the month of December. Now, that was for a whole bunch of reasons, but nonetheless, I mean, if you remember your arithmetic, if you start at 100 and fall 6%, you're not back to 100 with a 6% gain. You actually have to outpace that gain to get back to break even. So the fact that the S&P 500 is up 6.2% over the start of the year, it does not counterbalance the drawdown that we had in the previous month. Although, again, it's the best start to the year since 2019. And as the old saying goes, so goes January, so goes the year. And there does seem to be some expectation of that. I'm a little bit more skeptical than most when it comes to that assumption, but nonetheless, that's where we are. The NASDAQ had its best start to the year since 2001, actually, which I think was really important, although a great degree of that was powered by the pullback in Treasury bond yields as investors bet against the Fed, and indeed some really big gains for the mega cap stocks. Google, Amazon, Apple, Meta were all up double-digit percentages over the month of January, and that was really the most significant driver for the benchmarks. Really, really strong start to the year.
Yeah, and a great reminder on the arithmetic, because if you go down to 94, 6% of 94 is only 5.64, not quite 6. That's at least what my calculator tells me. I'm not going to do that mental math off the top of my head, but thankfully for technology. And it's a great reminder there of outpacing. Obviously, the percentages change, so I appreciate that. Do you view this recent jump, or should we all view this recent jump that we've seen, these little pops in the market? We had at least one very notable 2 weeks ago, one big sell-off day, a couple big sell-off days, but overall, have these been a series of bear market rallies, or the beginning of a whole new look market in and of itself, I wonder?
It would be really difficult to see where the emphasis would come from for a sustained bull rally under these conditions. If we are indeed getting closer to recession, if the bond market is showing us an inverted yield curve, certainly between 2-year and 10-year notes, but also between 3-month bills and 10-year Treasury bond yields. If we're seeing slowdown in major economies all over the world, then it's really hard to sort of find the reason why stocks would be rallying to this degree. Furthermore, JD, the earnings season thus far has been far less than spectacular, it has to be said. And we're looking at fourth quarter earnings probably about 8 to 9% lower than they were this time last year, once you strip away the energy sector, which can't be relied on for consistent profit generation. So I really think that a couple of components that were in play this month, the big cap tech stocks, as I mentioned, the fact that a lot of money is put to work by fund managers and others in the beginning of the year, and it's not replicated over the coming months, so therefore the gains tend to peter off a little bit. And the fact that you had some reversal of the tax loss harvesting that we saw in the month of December, which generated that big drawdown. So I'm certainly not in the camp that this is any kind of bull rally. I don't know if it's a bear market rally. That will be sort of further understood over the coming months. But I wouldn't necessarily put money down on this momentum, at least not until we hear from the chairman later today, and potentially even further digesting some of the inflation dynamics and get a reading on what the tech companies are going to say tonight with Meta, and then of course tomorrow with Amazon, Google, and Apple.
That's right. We'll get Meta's information at 5 o'clock. We'll talk more about that in just a moment here as we pivot to earnings here shortly. So perhaps it's a bit premature to apply the traditional logic of as January goes, so goes the year, because this is not any normal year. Am I correct?
I would say so. I'd say it's not a very normal year, but nonetheless, you do sometimes the broader momentum of just the fundamental fact that financial markets are driven by long-only investors. In other words, as much as we would like to think that people are able to manipulate the market in either direction by putting on short bets or doing all sorts of other tactical things, at the end of the day, the biggest push in value in any market and anywhere in the world is the fact that big portions of money enter it and they push prices higher. And that's goes a long way to explain what we saw in January. Fund managers, hedge funds, pension funds, everybody else will come into the start of the year with fresh capital that they then put into the marketplace in order to put it to work. And that has an upward bias as a result for stocks and a whole host of other things, particularly here in the United States. And I think to some degree, that is what we are witnessing right now. Will that peter out over the months ahead? A lot of that is going to depend on certainly what the Fed says, what the big tech companies say about their near-term profit projections, and ultimately where we see the earnings scorecard fill out when this earnings season wraps up in a couple of weeks' time.
Martin, what aren't we paying close enough attention to?
Gosh, that is a great question, JD.
See, this is good for our viewers to know, because you truly don't know the questions I'm going to ask you. I don't even know the questions I'm going to ask you. I mean, largely we do, because our producer Rebecca is incredible. But as I sit there, things come to mind, and I was like, I don't mean to put Martin on the spot, but you are as savvy a viewer of business media as anyone, and I wonder if there's ever anything you think of as like, we're talking about that a little too much. We're not talking about that enough.
I would say two things will spring to mind, JD. I think the first is that we ultimately don't know what the impact of China's reopening is going to be. And that might not mean that that might not necessarily indicate that we're not paying attention to it, but it is a known unknown at this point, to steal a line from Donald Rumsfeld. We know that the economy is reopening, and as a result, that is going to be a powerful force in global growth. The IMF has said pretty much the same thing earlier this week when they lifted their growth forecasts, not only for China, but for the global economy itself. What we don't know, JD, is whether that expansion is going to be inflationary or whether it's going to be disinflationary. And by that, I mean, if China decides to emphasize export-driven growth in order to get back to level pegging in their economy, that's going to be good news on the inflation front, because essentially what it's going to mean is greater exports at cheaper prices, exporting deflation to different economies around the world. If they decide to retool and focus on consumption growth and therefore sort of spending and consumer-led expansion, much like we have here in the United States, that is absolutely inflationary, because of course it's going to drive commodity prices higher and it's going to slow export growth. We don't know exactly how China's going to play that just yet. We may not know for several months. So I think that's one thing that requires a bit more attention. The other thing I would say more immediately, JD, is I'll come back to earnings, and I'll say that I don't think the market is respecting the fact that earnings have come in so poorly this quarter and are probably going to deteriorate between now and the end of the reporting season. And it's very likely that we'll get negative earnings over the first quarter of this year as well. That will put the S&P 500 in an actual earnings recession, 2 consecutive quarters of contracting profit growth. That won't require any kind of 18 months later analysis from economists sitting in a room talking to one another. We'll know it in real time. And if that is the case, it will be very difficult for the valuations that we're seeing in the market right now to be justified.
All right, let's pivot now and talk about earnings. Shares of Snap, if we could start there, plunging after reporting a pretty rough quarter. That was end of day yesterday, I think. I think that was after the bell. What do we learn? What's up with Snap? Also, I feel like we've had this conversation I remember being here when Snap went public. That's years ago. That's like 2017 or so. It's like, is Snap a technology company? Is this a social media company? Does Snap know what it is at this point?
Yeah. It's a great question. I think it has the potential to be a really powerful social media tool. I have a daughter who's 18 years old. She relies on it as probably her principal form of communication to all of her friends. And as a result, she uses it quite frequently. It's impenetrable to me. I'm not even sure I understand how to use the platform, but I do respect it, given the fact that it does grow monthly users or daily active users pretty much on a quarterly basis. And the time people spend on the platform is also growing as well. What they're stuck in right now, JD, is sort of a two-pronged attack. Apple's privacy changes make it more difficult for them to track users and give them targeted ads. And at the same time, advertising companies are pulling back on spending, and that's having a doubling effect. So that's why they've tipped into a loss over the fourth quarter of last year. It's why they are expecting ad revenues to decline in the first part of this year. But they are making major changes to their infrastructure, which is going to sort of ease their reliance away from the Apple privacy issues. And also potentially, JD, if it turns out that the groundswell of lawmakers going after TikTok ultimately ends in its being banned here in the United States, Snapchat could step forward very, very quickly as the platform of choice for a whole host of young people. So I think there is potential there. The stock has done very, very well over the past 6 months, considering what we've seen for some other media companies. So today's decline is significant for sure, but from what I'm reading from analysts, they actually like the potential for this company. At the moment, it just hasn't been able to get out of its own way.
I feel as if maybe when TikTok actually does get banned, I'm not just talking like federal device ban, I mean an actual legit ban, we're far off from enough members of Congress being anywhere close to supporting something like that. But if that happens, I can only imagine Mr. Zuckerberg would be very quick to jump in and say, hey, listen, Instagram Reels, it's basically, we copied it. It's basically the same thing, folks. We'll just, come on, let's just increase our own market share. There'd be more than a few other non-Snap competitors, I suspect, willing to jump in. I don't get the Snap phenomenon myself. I'm kind of more in your camp, but I know it's important. I know the geolocating features of it make it, I don't know if it's quite proprietary, but it's very potent. And I'm sure you judge anecdotally as a father, that's the type of thing that a lot of young consumers specifically spend a lot of time on. And that's part of the point, right, of any of these apps, is to encourage people to spend as much time as humanly possible on them, for good or for bad.
Well, that's what it does. I mean, ultimately, monetizing it has proven to be more difficult than they thought. But if you do have these faces in front of the screen, you're at least halfway home. That location thing you're talking about is actually really quite fun. you sort of look at it almost like a Google map, and you see avatars of all your friends and people you follow and everything else, and where they are at any particular moment. So my daughter actually, that's a good form of their entertainment. Oh, my friend is at this tennis court or that shopping place, or is visiting here, and they can narrow in and sort of send the messages and ask questions and chat and all the rest of it. So it's an interesting way in which they are able to establish their social networks. And it's interesting to me in the sense that to some degree they've abandoned the idea of sort of privacy and anonymity in favor of that instant communication. It's not a moral judgment. It just seems to be the way that they want to live their lives.
Absolutely, and I fully respect that. It also sounds horrifying, what you just described. I don't know, maybe I'm in my mid-30s now. Maybe if we had this conversation 10 years ago, 15 years ago, I'd say that sounds amazing. But now I'm sitting there saying, wait, I don't want to know. I don't want to know where my friends are. I don't want my friends to, I don't want anyone to know where I am at any given time. Granted, anyone watching this knows where I am, but like when I go home, it's like, I mean, come on. But I point well taken. Obviously, there are components of it that could be utilized beyond just the simple user experience, and I'm sure flashes dollar signs in the eyes of advertisers or whoever else, however the platform runs. Clearly, I don't open up Snap very often. All right, let's talk semiconductors if we can here. AMD, the company, reporting a pretty big beat in its fourth quarter. Martin, you got any highlights for us? What should we know?
Well, I mean, the chip sector's just been so beaten down. Investors are looking for any sort of positivity from some of the most important companies. Advanced Micro Devices, of course, is exactly that. They've got their fingers in PCs, they've got their fingers in gaming, in data center, in AI, in cloud, and just about all the rest of it. And they're taking market share from Intel, which had a grisly update last week for not only their fourth quarter, but their projections into the start of this year. AMD's beat wasn't that great, a little bit higher on revenue and essentially matching at the bottom line. But what they did do was forecast solid, by no means spectacular, but certainly solid near-term revenue growth. They say the data center business is going to offset what everybody knows is going to be a pullback in PC sales, but they say that they're primed for the recovery in the second half of this year. And I think just set against what Samsung, the world's biggest chip maker, is telling us about price pressures. Samsung wants to maintain market share while keeping investment unchanged, and all that means is that we're going to have cheaper chips going forward as a result, with Intel obviously telling us about weakness in demand going into the start of the year. All AMD really had to do was tell the market something that wasn't terrible, and that's exactly what they did, and they're getting rewarded for it.
You want to talk a little Peloton? Are you a Peloton user, by the way?
I am only, at a gym or, at a hotel or something like that. I think the bike is probably the best piece of fitness equipment I've ever used. I think it's a spectacular machine. Its price point is just simply too high. But I have a lot of respect for it as a piece of equipment. It's an amazing bike. It's steady. It's sturdy. The sort of interactivity of it is fascinating as well. But what the company's doing now, JD, is really interesting to me. They're actually relying now more on subscription sales than hardware sales. And subscription has overtaken hardware for 3 consecutive quarters now. And as a result, that tends to have a little bit more predictability if they can hold on to their subscriber base and keep them within that ecosystem. And they imagine themselves to have about 3.1 million subscribers over the 3 months ending in March, which is going to be their fiscal third quarter. And as a result, I think investors are liking what they see with regards to that recurring revenue stream. They're also trying to sell bikes on Amazon and in Dick's Sporting Goods and other places in order to drive those hardware sales. They're getting their arms around costs, and they're basically reimagining the company after that pandemic spike, which waned very quickly once people started to go back to the office and go to gyms. So the numbers today, even though they did indicate a loss for that December quarter, they're reasonably optimistic going forward, and Barry McCarthy has done an excellent job in turning the company around. And if you go back and look at the stock's 6-month gain, it might be surprising because it's such a quiet rally for a stock that we mostly associate with bad news. But we're starting to see that turn the corner now, and it would be good news for people who have been patient with that company really since its pandemic drop-off.
You may not have a response to this because it's truly out of left field, but have you ever jammed on the possibility of Peloton being an acquisition target for anyone else
It,
out there?
well, it
I
has
always
been
wonder the
spoken
interest
about
of like a
before.
Nike and Apple, maybe.
Yeah,
Yeah, no, it gets
the
written about from time to time. I'm just wondering if
it does.
any names kind of, this is just speculation, but
It's a very sort of it's a thoughtful design in a way that reflects, at least in my thinking, the aesthetic of the iPhone. It would probably move seamlessly into Apple's desire to be more associated with the healthcare industry in a way that it could maybe mine some of the data from users in their exercise activity to help them out in that general sort of wellness space that Apple is likely wants to get deeper penetration into. The last thing I remember, JD, was Amazon being a potential buyer because, of course, Amazon has its own line of fitness equipment that it sells in the online marketplace. And, of course, Peloton putting its bikes into that marketplace as well sort of elicited some speculation that it might be folded into the group. That does make sense to me as well. But I do see this, and this is not to say that I have any reporting to suggest it's true, but it does seem to be more of an Apple purchase than an Amazon one.
all right, right on. Okay, let's talk Meta because that name is up after the bell today. Of course, the artist formerly known as Facebook. What are some of the main points to watch in that company's report, especially around, oh boy, digital ad sales? What are we going to learn here?
Digital ad sales is pretty much the entire story, I think, when it comes to Meta. It generates about 98% of their overall revenue. So what they have to say about that is exceedingly important. Now, Snap was certainly, I wouldn't say bearish. They weren't bullish on near-term projections for ad sales, but Snap was pretty insistent on reminding us that the issues they're suffering were company specific rather than ad based. So actually, Meta has the potential to maybe surprise on the upside. Meta last year, of course, you'll remember, said it was going to get rid of about 11,000 jobs in order to have deeper control of its cost base. So that is certainly going to provide margin improvement into the December quarter and indeed beyond. So they have the potential to surprise to the upside there as well. Reality Labs, however, the division which houses its metaverse ambitions, is still a bit of an anchor, and it's bleeding red ink, and it's likely to have losses, according to Mark Zuckerberg, that would have been deeper in the December quarter and stretch into this year. So to the extent in which Meta can tell us that the ad space is going to improve to such a degree that it can potentially offset the red ink that we're still likely to see from Metaverse, is going to prove crucial for this stock and holding on to the momentum that it had over the month of January. But that, to me at least, seems a bit of a stretch. I'm going into this with a little bit more pessimism, I think, than most investors, because I don't see ad spending rebounding in the way that a lot of people assume.
All right, right on. Of course, tomorrow, the big names, Apple, Amazon, Alphabet. We've already talked about them in one form or another in this broadcast, but tomorrow we actually hear and get to see what's under the hood. What are you expecting?
Yeah, all three have slightly different narratives, don't they, JD? I think with Apple, ultimately, it's a supply chain story. We want to know to what degree the disruptions in China late last year kept the high-end iPhones off of the shelves, and as a result, what that's going to mean for those December quarter revenues, and whether, with demand consistent, those sales will simply be delayed into the March quarter, which is traditionally the weakest of the four. With Amazon, we want to know exactly to what degree their job cuts are going to affect the cost base. Amazon has had a significant issue with rising operating expenses because of the fact that it has to hire so many people. It's one of the biggest private employers in the entire world. But they're trying to pare down their costs as consumer spending pulls back. And of course, their web services division is as sensitive to the global macro conditions as anybody else. Microsoft was a little bit gloomy about that when they updated on their earnings last week. Google will be much the same as Meta with respect to its reliance on the ad sales portion of the economic space. So what they have to say about that is extremely important. Their cost base too is under scrutiny as a result of the job cuts that they announced earlier this month. I think it's about 12,000 jobs going to go. So Google and Meta will be similar. Amazon will be very much focused on consumer and cloud, and Apple, for the most part, is going to be a supply chain story.
Is there one over any other that you are most looking forward towards of the A's tomorrow?
Yeah, Apple is the one, I think, JD, that I always enjoy the most. I find Google the most difficult. It might just be my sort of headspace, but I find myself having to read their earnings updates several times before I can really get a full understanding of it, and it's always been that way for me. Amazon, I do find interesting as well, a little bit, certainly a lot easier to understand than Google. But Apple is, very straightforward. We understand the components that drive it, both geographically and with respect to, the different revenue segments. Tim Cook is a straight shooter with regards to what he sees in terms of demand and disruption and headwinds and all the rest of it. So from a position of, what's the most influential and what's the easiest to understand, they generally both dovetail into Apple earnings.
Absolutely. Okay, well, we've got all that and so much more to look forward to tomorrow. And of course, we will be closely tracking the FOMC decision at 2. We'll hear from Mr. Powell at 2:30-ish. We'll see what time he actually takes to the lectern. My special thanks there to our senior editor and chief markets correspondent, Mr. Martin Baccardax. Martin, enjoy your well-earned sushi. I hope you get some sleep, because I know you'll be up very early tomorrow morning writing all this and so much more for TheStreet.com, as you always do. Martin, thanks a lot, man. Appreciate it.
Thanks, JD.
All right, folks, that is going to do it for The Street today on this Fed Day edition of the show. Stick with The Street for more on these and all of the major market stories that matter to you, and we will see you tomorrow.